All right, so let's look at how we would go about recording the purchase of inventory. And what we're primarily focused upon here is making sure that we capture all costs that can be added to inventory. And so we've got a scenario here with this company that has purchased inventory. We don't know what it is. And that we've been provided with some information here. The invoice amount is $4,000. There's some shipping charges of $240, and let's see. Looks like the buyer is paying these charges. We have interest of $80 on the $4,000 that they borrowed to finance the purchase of inventory, and then finally, there's a $40 cost of moving the inventory to the company's warehouse. Okay. All right. So we're going to look at each of these, and then they want to know the total, determine the total cost of the inventory, and then they want to record all of these items using T accounts. Okay. Very good. So let's see here now. We have an invoice value here of $4,000, and that is where we should start off. Now, one thing that we do not have in this particular example is we don't have any discount, purchase discount terms such as 210, net 30, anything like that. We do have $240 of freight charges that we're going to want to add to that. However, interest is a peripheral item on the income statement only, whether it's interest expense or interest revenue. So we're going to not count this $80 here, at least in terms of inventory value. And then finally we have D, $40 for the cost of moving the inventory to the company's warehouse. So I'm not exactly sure what they're talking about here because we had the shipping charges up here. However, if they did incur an additional cost for moving the inventory, we would want to include that. So our total inventory value then is going to be $4,280. All right. And then we have some T accounts down here. So they've got these labeled A, B, C, and D. So rather than, they don't want us to just plot this 4280. It doesn't look like anyway. They don't want us to just plot that in. So what we want to say is that we purchased, looks like, let's see here. Purchased, okay. So let's think about this. We're going to have to assume, based on the set of facts that we have, it says here that we've got inventory for $4,000. It also later says here that we financed some of this, that we financed this purchase. We got some money from a bank. So with that said, a couple of things are happening here. We appear to have we purchased this for cash, but it was borrowed cash. Now, we don't have in our T accounts here, we don't have a T account for cash. So we're just going to have to take this item by item. And we know that the invoice amount was $4,000 for inventory. And inventory goes up on the left side, which is because it's an asset. For $4,000. The closest transaction that we have to match this to would be the loan that we took from the bank. So we have a note payable for $4,000 that is also associated with this transaction in A. Now, we do not, again, we do not have a cash T account, so we're going to have to assume that these shipping charges here, which are an inventoriable cost, were charged. Essentially, we have not paid the $240 yet. We would still add that $240 to inventory, just as we did up here in the step above. But what we're going to do also is we're going to set up a short-term payable. And again, this is all we have. We have to deal with the information that we have, and we have to balance this out. For every increase, there either has to be a corresponding decrease, or in this case another increase, because we're dealing with an asset and a liability both. All right. So when we look over here with the interest expense we have of $80, well, expenses have a debit or left side balance, so we can enter that in pretty easily. And again, no cash T account, so we will have to assume that this is an interest expense that has not yet been paid but will be paid fairly shortly. All right. And then finally, we have the $40 cost of moving the inventory. That is an inventoriable cost. We said so right up here. So we're going to plot that $40 here. And then we're also going to assume that we paid somebody, or that we are going to pay somebody. So we have a short-term payable. And so then what we can do is we can tally these all of these items up. Now for inventory, we can just drop down this figure that we already calculated. So we have an inventory value of $4,280. We have a note payable totaling $4,000. We have short-term accounts payable of, let's see here, $240 and $80 plus $40 is $360, and then we have interest expense totaling $80. And that is all we have to do for this particular exercise.